substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. We can't look at this, guys. Like, my strategy is you buy it and you hope that you gotta get spotted. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Good morning, everybody. Well, it is Tuesday. Hopefully it's a little bit calmer of a day today than it was yesterday, because yesterday was a little bit too much. But we don't have any big economic numbers today, at least not, well, we got JOLTS jobs openings, but there's a 52-week bill auction. But it looks like the big mover today will be a couple of speeches from Federal Reserve members that we have at the top of the hour. And you can see already, if I come over here to the DOM, like fairly constrained ranges here. Morning, D Lightning and Mustafa. How are you guys doing? So I like to see all of the people that come in and are there like right at the beginning, right? You guys are the winners, I think. You're here early, you're working, right? Oh my gosh, I just pushed my my sticky notes off the table. Okay. So let's start with this daily chart here of the treasuries, because yesterday was a pretty big breakout from this cluster of just insane volatility that we've had over the past week. And it looks like we may be starting a new trend upwards and heading towards this 50-day moving average, which will probably converge somewhere around like 116 and a half or so. Or if we look at the overnight action, like we're continuing to move up, but nothing too crazy. It's pretty constrained today. And here's the S&P 500. The S&P 500 is just going. So there's a lot of short covering in the S&P 500. I think what you're likely to see here is the equities continue to move up and the treasuries maybe back off a little bit because this jobs number on Friday is a pretty big deal, right? So I think that's why you're seeing that. Oil continues to move up as OPEC is eyeing a cut. OPEC is eyeing a cut. Natural gas still kind of down in the doldrums over here in the US, and then gold and silver having pretty big breakouts here. Wow, especially silver. Silver is just taking off there. We got copper. All of the metals doing okay. And we come over to well, there's the dollar. The dollar continues to show some weakness, although granted, anything over 110 is still like really crazy, right? So maybe back below 110 today. We'll see. And then here's Bitcoin. Bitcoin's still chilling within a range. Given that the dollar is getting weaker, you might see some strength in Bitcoin though, right? So other thing I want to note, because we have been kind of keeping an eye on Credit Suisse, people are still kind of thinking they might do something over there. The order flow, I need to change this indicator so that it saves it, but it wasn't anything too interesting yesterday. Now, you know, this morning we are a little bit higher. So at the moment, it kind of looks like the alarm bells that everybody was ringing over the weekend about Credit Suisse, nothing's coming out of it. And Scott, all right. Good morning, Scott. So usually there's about 4 people that come in here, and I'm always wondering, okay, so who is it? Who's coming here at the start of the stream? So, cool. Well, let's just come in and check in on a couple of things. I'll let this guy have image privileges. Early birds, yeah. Well, I mean, some of the best opportunities in the treasuries happen right now. Although I kind of suspect that trade in the treasury market might be a little bit iffy We'll see if the Fed speakers at the top of the hour have anything big for us. I mean, especially if they comment on anything related to what happened yesterday in the markets, then that could move us. If that doesn't happen, I'm concerned that we might have a difficult week. So let me come over here to Forex Factory and look at the weekly VO so I can see like what's coming up in the coming days. So tomorrow we get ADP and services PMIs. Remember, we got like manufacturing PMIs yesterday where what moved us. Yeah, okay, so tomorrow, if that ISM numbers comes out like that employment and services is bad too, then look out. It's gonna move, right? Then we've got a bunch of Fed speakers and then the non-farms. So yeah, it might be one of those weeks where you don't quite get the action that you want because of the non-farms jobs number on Friday, right? This guy that's been posting that it's taken him a little bit to get him going, but he wants to contribute, I think, and he's acting like he thinks he's big news. So let's see what he gives us. I got a couple of things floating through my head here. Okay, so first thing, let's just scroll back here on Twitter, see if we got anything interesting. Taleb has been quite chatty lately, but hasn't been saying a whole lot of stuff that would be super useful to us. But maybe that's good for him. You did not attract as many trolls. Okay, Brannigan Barrett, what's he saying today? Markets are at it again with the RBA now having pivoted and effectively signaled peak rates. We are seeing gamblers place their bets that the Fed is the next to pivot. What is interesting, however, is markets is now pricing in a shallower peak in rates for Fed and a pause for most of 2023. Market pricing in only an additional 125 basis points left to go, with a likely 75-50 at the November-December meetings, and then the Fed pauses for most of 2023 with a single 25 basis point cut in late 2023. Given what is happening with volatility in markets currently, it is unlikely the Fed will push back against this rate path. That said, any hint at a pause or front loading being complete will bring all the cash off the sidelines simultaneously. So I think so. So like what I'm seeing and what we were hearing over the weekend is basically like they're not going to pivot. That they're going to bring interest rates up and then they're going to leave them there for a long time. But it does look like the front loading may be done. They tried to front load things at the beginning. I don't know. Maybe it's you front load until things break and then you back off and then everything's okay. I mean, listen, if nothing if nothing horrible breaks, I don't think that it's been like, you know, a disaster so far. Of course, some investors lost money, but like nothing, we haven't lost anything important, right? So if we don't lose anything important, maybe the front loading worked. Maybe maybe, I don't know. Oh, Jeffrey Gunn, like the highest yield lately on the 2-year treasury was 4.37. Closed today at 4.04. The highest yield lately on the 10-year was 4 and closed today at 3.61. Okay, so he is pointing out the 40 basis point drop in interest rates that we've gotten this morning. Michael J. Berry still sounding bearish. Yeah, this guy seems to believe in technical analysis. Not impressed so far. That's okay. That's okay. People can believe in technical analysis. Listen, somebody has to do it. right? Hmm. Al Brooks left the chat, right? I'm sure he's not liking my last video about price action. Okay, so we got that through. So, okay, so the next thing that I wanted to do was I changed my title to Live Financial Markets. I'm not 100% convinced that that's like the right title to use. You know what I mean? I'll come in here and look, like if I just say finance, Bloomberg, CNBC, blah, 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 blah. Yeah, it really seems to me that like day trading is the key thing I want in there. Live scanner, that's interesting. See, I used to have it. What did I used to have it? Good morning, Tobias and Brad. Yeah, I did have order flow in there, right? So if I just come to my playlist of past live streams. How's that? Stock and futures over order flow day trading live stream. You're getting an okay trend in ZN. I mean, for the kind of action that we're in, it was a decent move, right? Wasn't a ton of volume behind it. Jolting on some order flow. I think you're right. I think we should have order flow. Live order flow day trading. I feel like that order flow isn't the complete thing though, right? Because yes, we do watch order flow, but we're also really paying attention to the news, and I really want to try and grab more people that are interested in analyzing the news. You know, how do I do that? ZA, good morning. Invent a new term for it. Informed. No. So this is all about what are the right keywords for me. So it's not just keywords. So if I put live day trading, stock market. So I used to have live stock and futures order flow day trading live stream. Oh, it's stickball. That's right. Live stock and futures order flow day trading 4th of October 2022. All right. We'll just keep it there. I feel like that part of it is like if you come over here and you just see a thumbnail, right? Like what do you want to click and stuff. I don't know if mine is very competitive anymore. And like what is the title? Like the title could matter. Where do you get that little circle thing? Funded Forex trader, guys. Ugh. This is the Forex guys that is just sometimes I feel bad for because Forex trading kind of sucks. Forex trading kind of sucks. Mohammed El Areen, it's photo season. Okay. Scammers, yeah. Well, there is definitely a lot more shady stuff going on in the Forex market. I think that the futures trading crowd tends to be a lot more skeptical. Like the futures crowd still seems to very much believe in technical analysis and everything, but they tend to be more serious about it, right? So it requires a little bit of upfront investment and stuff, but they've come in and they've looked at it and they've said the best opportunity for me is probably in futures. I think that we could continue to see some up movement. I'm concerned about, you know, some of these levels above us, you know, like 28 or so could be difficult to break out from after that. I need to go through. I've been working on a little script to rename the thumbnails, or not the thumbnails, the details of all of my videos. And like going through and realizing like, wow, I have like 1,500 videos. It's pretty crazy to think about. I really like I think back on it when I was more into technical analysis than I was, and I really don't understand how I was getting anything from it. Of course, I always believed that news was important, but I didn't spend nearly as much focus on it. Once I started focusing on analyzing movements based on news and thinking of it in terms of meta order, the markets make so much more sense in that respect. Because otherwise I was constantly like, what the hell? Pattern, why pattern no work now? Right? Constantly in that. Very frustrating. Whereas here with news, when I'm like frustrated, I feel like I don't know what's going on. Like I know what to do. Like there's something for me to do. I can look at my trading and I can see where I probably shouldn't have done some things and stuff like that. And it's not just, well, it's all noise. You know what I mean? This price action video is doing really well. It's not the highest performing video I've ever had at this point, but about 160, 200 views in the first 24 hours. That's pretty good. And the impressions click-through rate is really high at points. I don't get any engagement numbers yet, but I'm guessing the engagement must be good. And It's still mostly going to subscribers though. YouTube has not been sending it to non-subscribers yet. You haven't seen it yet? Well, the thing that is getting me a little bit excited about it is that we already had a couple of comments in there. I haven't seen anybody arguing in there yet, but we've already gotten a couple of comments. I think that suggests that the video will do well in the long run. I wish there were more memes. You know what, Sky, you're right. You know what happens to me is I'll come in and I'm doing a video and, you know, I have the informational content that I want to get out. And then I go through, I write the whole thing out and I record it. And usually by the time that I'm getting to, you know, like finishing the script, I'm just like sometimes writing these are difficult. Sometimes finding the right words and getting all of the ideas that I want together into a coherent structure that makes sense to people is really difficult. And I can spend hours writing a script sometimes. And what I should be doing is then after I've gotten all of the informational content, looking back and thinking, okay, how can I incorporate as many memes and funny things into this as possible, right? But I just like don't have the energy by that point. This next time might be better because well, maybe not. And I'll be writing scripts this weekend. I want to switch off between writing scripts, writing, you know. So this week is a write script one. Although I do have like the video about my Jigsaw workspace is probably the next one that I need to do. So that one probably won't be funny. But I need to get into like more current market happening stuff, and I need to utilize some of the experience that I gained just trying to do funny stuff on TikTok, right? It's hard for me to switch between them. Anyways, that would probably do better. That would probably make things better. To break the seriousness of your great content, yeah. I mean, in my mind, I'm like, I want to get all of the most important, like to me, the most important thing is that I'm giving you guys all of the information that you need to give it a shot, right? Like I don't like it when I see followers, they come in, they want to day trade, and then they immediately get slaughtered. Of course, new traders don't tell me a whole lot about what they're doing with their trading, but like, you know, that's what I'm trying to avoid is I want them to come in and understand the market enough to at least stand a chance, right? And so I've been more focused on just getting the content out there, even though I know that it's not the most entertaining content, right? And then once I've got that through, I can try and make more content that has to do with, you know, that would be entertaining. And what keeps happening is like, I'll get a bit of content out there. I'm like, this is the last bit. And then like more stuff comes up. I actually think that we're pretty close to the end here. So I still need to make a video that's kind of more about macro stuff. So we've made one about the Federal Reserve. We need part 2, which will basically be macros, particularly in regards to treasuries. I have one. I don't remember what it was. I have like on my little notepad here the scripts that I'm supposed to write, and one of them I wrote breakfast. I wonder if that was like a rundown of my morning schedule and how I go about that sort of stuff. But now I'm like, that can't be it, because I don't think that would make a good video. But I need to make a video about the Jigsaw workspace and a video about the macro stuff. And then one of you guys said that I should do a video about the strat. I looked at that one, and I think that would be a good one to backtest. I think that almost all of those patterns that they have are candlestick patterns that are built into NinjaTrader. So you just have to put in like the stops and targets and stuff. So, and that one did have like some success on YouTube. So I think that we can go with that, run with that. It seems like this video format. So like I always had problems with my videos where like I was backtesting stuff and like those videos didn't do as well as I thought. And this one did do well. And I think that I've kind of zeroed in on the format and the titling and everything. I think that some of them didn't do well because of the titles, but if the channel takes off, let's just say that this video like really goes, and then we start getting lots of viewers coming into our other videos and the channel takes off and we have a little bit of cash to work with. I think the first thing that I would want to do is find a better video editor / thumbnail creator and have him go back through and look at some thumbnails that might be underperforming and try to improve them. So there's a few that I thought would be really, really great, but I just couldn't get a good thumbnail. Don't like the way the treasuries came back there. That might be giving us a good opportunity to get long though. But that move kind of suggests that I was right about it being a little bit more of a middling action. Like probably biased to the upside, but they might have difficulty getting all the way up to like 114, for instance. So Nick Timiros, CoreLogic reports U.S. home prices fell 0.7% in August from July and rose 13.5% in August from a year earlier. CoreLogic forecasts prices will be flat in September from August and that they will rise 3.2% over the following 12 months. And Bloomberg reports one of the 2 Nord Stream gas leaks in Sweden's exclusive economic zone remains visible on the surface of the water. So can I tell you, I heard an interesting take on the pipeline bit. So something that I notice when like an international incident occurs is like when I'm confused. Well, let me qualify that. Like something is being reported, but I'm not being given enough information to make any real conclusions about anything, to the point that it's almost like, why is this even being reported? Sort of a thing. And when that happens, I'm particularly noting like, how is the US media presenting it, right? And so I will run into some situation, because here's the thing, like journalism should be a science. Okay, I think that journalism is a science. Journalism is the science of current events, and so it should be just like a science. You have to go and collect empirical facts to prove that something happened the way that you say that it happened, right? But that's not what journalists do anymore. I think that a lot of journalists are just copying stuff from other people on the internet, is a big part of it. I mean, I get a lot of my information from primary sources, like, you know, I want to be seeing exactly what the Fed is saying and stuff. But the reality is that a lot of this will just come from other news sources, right? And so a lot of journalism is just copying and pasting other people's stuff, right? Or you have like your contact at the government. So when you come into a situation like this, what does that say to me? The government is not too interested in saying a whole lot about it. Isn't that interesting? Why is the US government not too interested in saying a whole lot about it? Well, some people suggest that it's that the US did it. I think that's highly unlikely. because you would have to be like going into another country's waters. So it would have to be like Sweden is involved in the conspiracy, and all. I think it's unlikely. But if you go over into Europe, and especially you go into the Baltic countries and what they're saying about it, it's a little bit different. And what are they saying? They're saying, well, like, this was not a simple thing to do. Like, it would have been many, many tons of TNT, and how do you accomplish that sort of thing, and yada, yada, yada. And so what they're suggesting is that Russia blew up their own pipeline because they have no intention of sending gas through it anymore. And they're doing it to show their capability, essentially. You blow up your own thing to show everybody that you can do it. And why would they want the West to be able to see that? Well, the pipeline's not the only thing in that water. So what the Danish and other Baltic state media is suggesting is that Russia was doing it to say, hey, look, we can go and cut your internet cables if we want to. We have the operational capability and technology to do this. Do something that it's hard for you to do this sort of a thing and do it without being detected, but we've done it. We developed the technology and we can do it. That's what they think. Isn't that interesting? That kind of puts things in a little bit of a different perspective, doesn't it? And to me, it's a little bit scary, because can you imagine we're sitting here, we're trading, and then the financial juice, like, they're in the UK. So like, just financial juice just goes down, right? Goes down because the internet cables were cut, right? All of a sudden, like, no internet is getting over to Europe and stuff. Wouldn't that be interesting? So a risk maybe to think a little bit about. Your channel just needs more ads and you will crash it. Okay, do you use footprint charts? So I have footprint charts. Sometimes I'll occasionally bring them up. I don't actively use them. Footprint charts are really cool. They're a great way to look at order flow from a longer term view. But what I think happens with footprint charts is that retail traders look for patterns and try to conduct technical analysis with footprint charts. And the kinds of setups that I see out there that are footprint specific, I've tried back testing them before and they're not very effective. You know, like the whole unfinished auctions and that sort of nonsense. So footprints are cool. If you are looking at getting into footprints, I would recommend that you just study order flow in general and the DOM, and go through my order flow series, especially like the last 2 videos in that playlist that I have, because that's where I go into the empirically proven behaviors of order flow that really make clear what you're looking for. Because what we typically think of is like, okay, I'm going to see patterns, and if I watch it enough, my brain will just kind of get it, right? Well, there is a pattern. It's a large meta order will come up and create a trend, and then it will stop, and that the market will kind of pull back and build itself a range. And sometimes they try to go too fast, and that will get them stuck, and they'll fall back into the liquidity holes. So you're just kind of reading the liquidity conditions. That's really what you're looking for, right? Once you understand those key empirically proven behaviors of order flow, I think it makes a lot more sense. And then you would kind of go like, oh yeah, all these things that people were looking for in footprint charts, probably not too useful. Check out the Zillow rent index. Rents are down. That means inflation will also likely come down because the CPI is heavily weighted on housing. Yeah, it's a little bit lagged though, right? But I think we have some reason to believe that maybe in the next few months, CPI will start coming back down. It better. Otherwise we're in for another real doozy of a down move. And I kind of feel like we've had enough. I've had enough, okay? I've had enough. Too stressful. Well, oil is looking good today. I'm wondering if now is a good time to buy oil. Because I'm thinking at some point they'll run out of stuff to take out of the SPR, and OPEC is kind of cutting things. And there might be like craziness over the winter, and then you have like things are crazy over the winter. So then when the summer comes, that'd definitely be crazy. Okay, this is a good message here this guy posted. I will give him permission. He was asking me if he could post his videos, and I was like, well, if you're participating. And so he did. So you can do it now, bro. How long? I don't know. I have to go back and look at it. The like the way that CPI deals with the housing bit is kind of weird, and is kind of leading to some of the stickiness in it. But I don't remember the details about that. Don't know if I'm in a super great position to look at it. I was thinking about like we could try going through no. So right now we need to pay attention. Right now we need to pay attention because for the next 20 minutes we have Fed speakers. So we should be staying frosty. But after that we could maybe go into the PDF. I kind of started the PDF thing. We could talk correlations. I'm wondering if I like write down the key correlations that we tend to see. Maybe I can kind of classify things. Maybe what it will be is like, here are certain environments that we've seen. So if you have this environment, rising inflation environment, you will see treasuries sell, you'll see equities sell, and oftentimes you'll see the dollar buy. The dollar, well, you would think that the dollar could be weak, but if the dollar is, when there's inflation, it's often that other countries are seeing more inflation than the United States. Ergo. But I'm wondering if I just go through those and I list all those, if that would be good. And that might be something that would turn into a video. Or no, but we could also put it into the PDF strategy. Because I was thinking, remember I was saying, oh, there's 5 of them. And I was like, well, one of them is predictors of order flow, and one of them is breaking news. But breaking news is kind of a predictor of order flow. And I was like, oh, there's got to be 5. Now I remember what the 5th one was that I could also kind of, and you could kind of categorize the 5th one under maybe some of the other categories, but the 5th one is volatility, right? You have to factor in volatility into your strategy. Well, we haven't written it yet, Trading Bunny, but I'm writing a PDF that I want to put out there for like, if you subscribe to the newsletter, or rather not the newsletter, but I want to have, well, I already have one. So if you go to speculatorseth.com/free.html and you sign up there, it will add you to the mailing list, and it will email you the set of free NinjaTrader indicators, right? So I'm going to provide another PDF that, you know, you sign up, if you sign up with your email, you get the free strategy. And the strategy won't have, you know, exact entries and exits, but it will talk about the 5 pillars, right? Predictors of order flow, volatility, correlations, and risk management, right? Those are the things that, like, you should have something that should be a part of your strategy. Those are like the 5 key things that you need to have and understand. So volatility, what do I do for volatility? Well, for one, if you come over here, I track daily volatility with this multi ATR thing that I have, right? So I can see what are the range of past days, what is the average range right now, etc., etc. Okay. Then another thing that I will do for range is swings. So if you see here on my 10-year chart, I have a swing chart on here to see, okay, that last move down. So we did have a move down of 16 ticks. So you notice typically these are around 4 to 5, and then the larger swings are like 8 to 10. But right now we're doing 16. So we're still in a slightly more volatile market than usual, but it's calmed down a lot since yesterday. But there's still some outliers, right? Another way that you can look at the volatility is our range histogram to kind of see the statistical properties of the volatility, right? So that's the volatility part, right? So that's what it's going to talk about. And it's basically going to say, like, you combine all those things together to do what? To say, okay, I have something that predicts order flow will come in. This is how I expect it to play out. Ergo, I should take a trade in this direction. And then I'm watching the order flow. Does the order flow correspond with my trade? Am I seeing the flow that I predicted? And then I can factor in things like the correlations to see all of the correlations are going correctly, and volatility to manage my risk, right? And that's what the PDFs can be. So I think it should be a really useful resource for people. I think, because it'll be a much more clear and concise, like, here's how you trade without using technical analysis, basically. So yeah, I don't know. 3.6 is looking kind of nice now as a long, but we still got these Fed speakers. I haven't heard them say anything too significant. Messer is at 715, might be one of the more important ones. So if I come back over here, Williams due to deliver opening and closing remarks at an online event in workplace culture hosted by the Federal Reserve Bank of New York. So I don't know if he will say anything too significant in that one. Due to speak at the Federal Reserve Bank of Chicago Payments Symposium, audience questions expected. Okay, so that one, given that it's the Payments Symposium, her comments may be more focused on that. So I don't know if these Fed speakers are going to be like huge deal today. But let's just kind of keep an eye on things for the next 15 minutes or so. Man, that order way back at 16 sticks out like a big thumb, doesn't it? Now, I also want to write a book where, like, for instance, your question about, you know, the whole deal with how housing is measured in CPI and why it might be sticky right now. So I need to go back and do a little bit of research to see why that is again. But the book, that's the sort of stuff that I'm going to be putting in the book. So if I ever get time to write it. Thanks for the efforts. Well, I'm glad you appreciate it, because sometimes it's really hard. Sometimes it feels like you're just doing all of this stuff and shouting into the dark. I always remember that, like, listen, there are people here every live stream chatting with me that are interested in what we're doing and care. So have you already been bombarded with the price action experts out there? Yes. Well, that's why I made that video about why price action is garbage, right? But the real reason why I did that one, or the thing that kind of made me be like, oh man, there's so much price action garbage out there, is we did a survey once. So it was on Reddit, it was on Futures.io, although I think that the majority of the people that found the survey went from Reddit. And the survey basically listed a bunch of different forms of analysis that you could use in your trading. And price action was far and away the most popular. Like it was like 3 times more popular than anything else. The one thing that people were like almost certain doesn't work was Elliott wave analysis. So I don't know why that was, but that was the one that they didn't like. So I always knew that price action was the most popular, and that's why I went after it. That's why I went after it. And to be honest with you, it was a little difficult for me to do, because there are some people out there that I really like that do price action, right? Like Matt, for instance. He does trades by Matt. He does price action, but I really like the guy. I don't sit and like watch him or anything like that, but you guys bring him up and he's turning into like one of the biggest guys in the space. He's certainly surpassed me in terms of popularity, and he seems like a good guy, but he is using price action, right? So I didn't want to make it seem like I was trashing on Matt. If I was trashing on anybody, it was these people that have been selling price action books and strategies for like 2 decades now. Like, man, there's this the most popular one, I think. And here, you know, when I trash on people, I like, when I'm really trashing on people, I like to not use names, right? But the really popular one, I'm sure that he's made his whole living on that. Those two, they probably make their entire living just on selling the price action stuff. Price action traders are beneficial for us guys because mostly they are the ones who are selling / buying too. Yeah, so I have a conflicted feelings on this one. So I saw an Andrew Tate video the other day where, yeah, I know Andrew Tate, but basically they were talking about, you know, it's so frustrating that so many people believe these things that he thinks are lies or whatever, right? So he doesn't really like directly say what it is, but you know, they're kind of in the monetary illusion kind of approach to things, that like money is not real and this is really all just a giant scam. I don't know if that means that he thinks that like we should be on a gold standard and that they don't like fiat money, but you get that kind of a vibe from what he's saying, right? And he's like, you know, it's why I was always so frustrated that people believed these things, but then I realized that like some people, a certain number of people have to believe those things, and because they believe those things, I'm able to benefit, is basically what he said. So his take was basically, well, I'm the rich guy and I'm, you know, I can be rich because there's so many stupid plebs out there, right? That kind of attitude like really rubs me the wrong way, but based on how we know the market works, that is basically what happens, right? Is that in order for us, an informed trader, when we are informed, to make money, there has to be noise traders out there and market makers for us to execute against. Otherwise, we can't realize our edge. So yeah, it is to our benefit that there's a lot of price action traders out there. But I just don't think that the noise traders have to be based on just complete noise, I guess you could say. I think there's room for the average trader to be more informed and us still make money, is the first thing. And the other thing is that there really is like we're at a disadvantage because we're going up against large institutions that have all of these resources, right? So in that kind of a situation, it really doesn't make sense to try and do it all on your own, right? Retail traders benefit by helping each other. Now, you don't want it to be to the case to the point where everybody in the market is following you, because then the edge will disappear. But, you know, a moderately sized community like our own can have a lot of success by, you know, teaching a group of traders some important things so that they can kind of share their resources together and help each other, right? Because now we're all together. When there's news going on, we can share the different news, we can share their perspectives, and we can say, oh, maybe you should look at this thing, maybe you should look at this thing, right? A lot of the stuff that we teach here on this channel that are proven things about markets, I wouldn't have been able to learn about them if it weren't for the people on this channel. And I'm just happen to be like honestly, like, this is really the truth, is that I just happen to be the perfect person for it. Because there's not too many people that have really high level programming skills and is really into finance and is not in the industry, right? Because the other people that have my skills, they're probably working for a big quant somewhere and making them money. And I'm like one of the few people that got enough of a glimpse into that world to kind of know where to go and learn about it on my own and try and utilize it, but not enough that, you know, I wouldn't be able to tell you, right? So that's why we're in the unique position that we are on, right? It would be cool if you could test the two-legged pullback strategy. Lots of people swear to gods on that. So the problem is, what's now going on in the market? Oh, wait, you know what? I missed that. I probably should address that. So Jay, just as like to get you up to date, we've had a few Fed speakers speaking right now. We haven't heard a whole lot from them, but I think the market is kind of waiting on them. We had a really big move yesterday, and we've got a really big non-farm jobs number on Friday. So unless we get like really big breaking news, it might be a little bit choppier today. Okay. We do get some data points at the top of the hour. Like what is it that we get? We get core durable goods and JOLTS jobs openings, factory orders at the top. So right now the market is just kind of chilling. Where would I go to learn about global liquidity flows? I'm not sure. That's the one where I'm not sure I know how I know this. I think the way that I learned this was from watching Fast Money on CNBC every day for years and years and years. And watching the market myself every day for years and years and years. And just going, okay, here was the dominant macro sentiment in the market, and here's how all of the different assets moved in relation to that. I think that's how I do it. I don't know. I mean, right now, the key thing that you want to know is that inflation has been the dominant factor in markets. And so inflation, you raise interest rates, and by raising interest rates, that pushes treasuries down, that pushes equities down. And then because the United States has been raising interest rates faster and more aggressively than other countries, that has been pushing the dollar up. And a strong dollar hurts exports. So like that's the main gist of what's going on right now. I read yesterday that lowering taxes strengthens that country's currency. Could you explain why that is? Okay, so for instance, when Donald Trump was in, they had like a tax holiday of sorts, right? Where they said, if you bring your profits from overseas into the United States, then we will not tax it as high if you do it this year. right? So the gist of it is, if you have high taxes, especially high corporate taxes, the companies may be prone to leaving their money, their profits, in other countries because they don't want to be taxed on it when they bring it into the United States. So thus, the lower your taxes are, that can lead to your country's currency being stronger, because it creates more demand for people wanting to move into dollars. Make sense? It's really what it all comes down to is, like, there's supply and demand for every asset, and then we look at what is the macro thing that everybody's talking about. How does that affect the supply and demand in each of those assets? And then you can just kind of track it. That's why I do this thing over here, because I don't really care about charts, right? But every morning I do come over here and I look at this and I say, okay, so ZN moved up, ES moved up, oil moved up. Okay, well, why might oil be moving up? Well, one, maybe because stronger demand, but two, because OPEC says that they're cutting, right? So that's what that flow is about. Natural gas not doing so hot. I guess that means that in the United States we have plenty of natural gas. Gold and silver. Why are gold and silver moving up? Well, gold and silver tend to move along with the treasuries, right? They tend to be positively correlated to treasuries. And copper is an indicator of global growth. So if growth, especially in China, if growth in China is going well, then copper tends to go well. Is that why Britain wants to lower taxes? So Britain wants to lower taxes because their economy is in trouble, right? They have to rebuild their economy to some extent from leaving the Eurozone. So they need to develop. So lowering taxes, generally speaking, would bring more money into the stock market for investment and would help you build that economy faster, right? But the problem is that you're in an inflationary environment, and printing money and putting more money into the system exacerbates that situation. So they can't just straight up do that. What they should be doing is they should be doing very targeted stimulus. They shouldn't be saying we're going to get rid of a whole tax bracket. They should be saying, if you are working in one of these industries that we know are important to resolving our supply concerns, then we'll give you a special tax incentive of some sort, right? And then you may have to raise taxes or cut services somewhere else to compensate. Well, this is interesting. It looks like the the treasuries may break out to the downside here. I mean, they're awfully close to that 16. They didn't tick into it, but they're awfully close. Seeing it down here kind of makes me want to try and take it long on the theory that that the buyers in the end will win out. But the way that it's been trading so far through the session suggests that it's really better for us, the informed trader, to stay out. What was I talking about? Oh, yes. David Marcelino asks, it would be cool if you could test the two-legged pullback strategy. Lots of people swear to gods on that. So the issue with strategies like that is that they are hard to quantify. What I mean by that is that if you come in and you say, so I think what you mean by a two-legged pullback is, we have a trend, it pulls back, you take the second leg. I think that's what you're saying, right? Okay. Well, so first of all, there is an empirical reason why this pattern happens. No, one that is, by the way, the two-leg pullback. Okay, can you show me how to find this automated? Because that's the whole thing, is like, how do you identify that you're in that situation? And nobody seems to agree. And when they can't agree, then you can't really have a back test. Like, they'll just say, well, but that's not actually the thing. Yeah, if you can send me like a video, or a place where they've specifically defined how to do it. So like the strat, that one is really good because you can test for those candlestick patterns. In fact, I'm going to bet you, because they're two candlestick patterns basically. So as I understand it, they like use 3 numbers, but really the signal is just 2 candles, and then that should result in a 3rd candle, right? NinjaTrader has basically all of the 2 candlestick patterns that you can have defined already. Well, that's interesting. So they did break through the 16, which in and of itself isn't that interesting. But after they broke, there was, okay, so let me see here. About 1,000 of it pulled, but they still traded it. And then about 3,000 traded at 15.5 after that as well. So I'm wondering why there's so many orders looking to sell there. That might just be robots, and they maybe just kind of had a little bit of a rug pull. I'm really wonder why they wanted so many contracts there at 16, 15.5. But they have pushed through it, so. This guy has it automated but takes trades discretionary. Wow. So like this is the thing that drives me crazy, is like you'll backtest something and they'll say it doesn't work, and then they'll say, well, like it only works when you have this other edge to accompany it, right? Like we say that with order flow, right? Well, order flow on its own might not necessarily help you too much, but when you are an informed trader, then it can help you a lot. And the counter argument to that, I think, is, well, if it's not an edge on its own, then what makes you think that it will be an edge in any situation? Okay. Well, with order flow, the reason that we think it would be an edge in any situation is because we have a lot of empirical data proving certain stylized behaviors that order flow exhibits. For instance, strong correlation with the direction of orders. If you see a buy order now, you're more likely to see a buy order in an hour from now, right? That's one that we know, for instance. Okay. But when you're getting into like candlestick patterns, what empirical data do we have to show that there's any kind of statistical abnormality with candlesticks that causes it to tend to go a certain way? We don't have any. I think that some people think that they see one because they aren't discerning enough. They aren't putting enough data at it. They're not analyzing it deeply enough to recognize the flaws, because the market is really good at hiding that sort of thing, right? The market wants you to think that there's a pattern there so that you'll trade it, and then the market can screw you over, right? But if they have simple rules, if X then Y, then entry at this place, that's good. We can backtest it. It's just the whole thing is like, if it's a really good technical strategy, why use discretion with it, right? The reason we use discretion is because our primary edge is knowing what's going to happen. And the way that we figure that out from breaking news and predictors of order flow is something that robots can't do very well. Should you order orders by size, like less than 100 or 10 contracts? So yes, but you're more likely to find useful information by filtering the other way, only looking at orders that are yay big. So Oliver, when you post links, YouTube will censor them. So you have to post the link to me without any of the stuff that identifies it as a link. Like you have to omit the .com part, or like put spaces and get rid of the period, that sort of a thing, and then it will let you put them in. Or post it on Discord if you have permissions on Discord. Or get on Discord and message me. Get on Discord and message me, and then. So we had an outside week on Tuesday prior to the cash open on Friday. After the close, I thought we would now break much lower. No, oh, okay, so there you go. 2-leg pullback. Oh, and it's in NinjaTrader. Okay. So I'm going to bet. Okay, so first of all, it says get your lifetime license at timekeepertrading.de. So only for NinjaTrader 8, how it works. Get it now. How much is he offering it for? $143. No thanks. So here's... I watched the video. It's rules based, so you could implement it yourself. Okay, I'll watch the video. Cause I bet I know. I have a couple of thoughts on how we might be doing that. So with a like a 2-legged pullback in, well, okay, so like zigzag, right? How does zigzag work? Well, zigzag will say we've moved down, and because we have now moved back 2 ticks, we will say that is the pivot. And if it immediately goes down lower, then we say, oh, that wasn't actually the pivot, and we just redraw it and we move it, right? And then we don't actually have a confirmed pivot until we've come back 4 ticks or whatever it is that you set in the indicator settings, right? Well, that is back testable, but not with the logic that NinjaTrader has built into it. Because essentially what you have to do is you have to define when it is confirmed, essentially. So you have to tell the indicator, okay, when it's actually pulled back 4 ticks, then I can draw it, or then you can try and trade off of it. And that's how I was able to back test the setups that I talked about in the price action video, where I was doing pivot highs and pivot lows and stuff like that. That's how I was doing, is I have an indicator that it, has methods that trigger when a confirmation is made, essentially, so that it knows the point at which it can actually take a trade, right? And so this introduces a big problem though, right? And that is that you don't get the confirmation until it's already pulled back like 4 ticks. So you're always getting in late, essentially, right? And so I've often found that, like, by the time it's shifted, it's too late, sort of a thing. Because you'll see, like, the one that I think is the most interesting to watch is like, well, so for instance, here on the S&P 500, okay, we've had a move up. So we have not had a pivot high yet. So you could potentially come in and say, I want to be long until we've had a pivot high, which means that you have a bar that closes below the previous bar's low, right? That would be like a pivot high. Well, they really broke lower here in the treasury. So I'm glad that I didn't take any trades, because I don't have anything telling me that we should be seeing order flow to the downside, but it did come through. It reminds me a lot of yesterday. It's kind of around the same time, in fact, when we're getting this selling, and so maybe it's coming from the gilts. But it also kind of feels to me like they traded the big orders at 16, and then once that happened, everything, chaos just kind of broke loose. But we could try duplicating it. But I'm that might be part of how he's doing it, right? So when you do that, and you basically, the gist of it is that you can kind of fool the backtester sometimes, right? So that one might take a little bit more work to backtest, but I can look at that one too. Because when we have something that's popular and it's quantitative and like we can really backtest it and show the flaws in it, then we want to do that for sure. Those are I think good opportunities for the channel, even though they're a little bit more work than your standard video. And keep that open. That indicator might be difficult to do. So the pivot, maybe I should include that in the indicator suite now too. Now that John, I was saving it because I thought that maybe we would sell it together or something, and it never happened. But now that he's gone, I think that I will just put it into my indicator package. So it's something that other people would sell alone for like $100, but like the logic for it is really complicated. Turns out the logic for those ends up being really complicated. Robert Ballin thinks the 10-year yield is about to make a trough at around 3.78 and then ratchet higher. What kind of pivot is it? So the way that we're defining pivot in my pivot indicator is bar that a pivot high will be formed when you get a bar that closes below the previous bar's low. Right? We need an orange candle where the orange closes below this previous bar's low. Then it's a pivot. So this is kind of interesting. The S&P 500 is looking really positive, and meanwhile, the treasury market is just falling apart. I like the open, but what I don't like is when they push the indices to crazy too fast up. I would rather like to see some pullback on the way up. Well, it's only been 15 minutes, so it often will, when you're getting a really strong trend, it can take like up to 30 minutes to an hour before you finally see a pivot high. By the way, let's see what's going on in Credit Suisse. Credit Suisse moving higher. Okay, so Fed's Daly is speaking in a CNN interview. Maybe the driver to the downside here, possibly. We'll see. This flow, once we broke down, like the flow to the downside, especially in the 30 years, started to become very strong. I am seeing flattening on this move as well. So it's not so much in the 10-year. The 10-year seems to be lagging a little bit, but the 5 and the 30 are just pushing down very, very aggressively. I'm kind of in the mode of like, I suspect that this could reverse and push back up higher, but that is so strong. There's no way I want to get in front of that. Maybe, oh, it already has, I think, Tobias. Maybe Credit Suisse will replace Deutsche Bank in terms of reputation soon. It is, but like that's why I'm skeptical of the whole Credit Suisse thing, because you remember way back, I don't know if this, I think this was before you were around, Tobias, but back in 2018, 2019, there was a guy that would come in and was here regularly, and they were just obsessed with the Deutsche Bank thing. They were convinced that Deutsche Bank was about to go bust and that it would be 2008 all over again and all that sort of stuff. And it just never happened, you know? So that's why I'm skeptical with the Credit Suisse thing, because I've seen so many times where it just kind of fizzles and nothing ever comes of it. The 2008 happened once, but I'd say that people claiming that 2008 is going to happen again is something that I see every 3 months. Right. Fed's Dally. Americans believe the Fed can reduce inflation. You know, so this move, I don't want to trivialize how strong the order flow was to the downside. It was about 7,000 contracts to the downside, but we're still in a very illiquid market that exhibits very high volatility. Because in normal market activity, this would just be a little sneeze, you know? Ed Sally says there's a lot of room to slow down the labor market. This guy that you guys told me to follow, Robert P. Ballan, he's saying stuff about the treasuries this morning, but I'm not quite sure I understand what he's hinting at here. Waiting for a 10-year yield rally to 3.58%. We execute buyback of equity short hedges when that happens. PAM model suggests uptick until October 4th. But that's not where we're above 3.58, bro. We're above 3.58. So, first of all, that doesn't make sense. Years likely peak. Maybe when he says a rally, he means that the yields are going to come down to 3.58. Good bounce there, though. You see that though, where like it doesn't take a whole lot to make a bounce. I expect that unemployment will rise to 4.5%, not 6.5%, says Dally. Uh-oh. Did something happen with my advanced cumulative delta? Yeah, yes I did. I'll just refresh it here. It is a strong move down in ZN. I mean, the problem I think I got with a trade like this is the chances of it snapping right back to 113.16 is really high, I think. And I'm not saying that based on, I think there's a buyer out there, he's going to buy it. I'm just basing that based on the volatility of the market here. Carl Quintilla, another day of outsized positive breadth. Only 3 S&P 500 names are red. Yeah, so another thing is that equity is moving higher here, even while the treasuries are under pressure, is a little odd. Should I say odd? It's not what the markets have been doing for a while. So that's. Did I say that the market volatility is based on TA? Well, so this is a situation where you could use the TA just to judge what the volatility is, but I'm really relying on the order flow, right? I'm just coming in here and saying, look, all it would take is like 5,000 contracts and they're going to be right back up there. No, don't joke. I can't take jokes. Well, maybe they're going to come back down. Like, that's the whole thing, though, is as I can come in here and I can say, well, there's a chance that it comes all the way back up, but that doesn't give me a trade, does it? Like, I need to have a reason to think that the flow is going to be tilted to one way or the other. Especially to take a reversal, which I'm not seeing. I'm seeing the flow come the other way. I'm definitely seeing the flow come the other way, but I don't know why. But then again, I don't know why it fell apart in the first place. It's kind of weird. Somebody just decided to take the trade, I guess. I was thinking if there is a better way to model / track the current state of a recession. I mean, when the NBER announces that we're mostly already in a recession, right? There should be better indicators. Well, the issue that you have with any kind of a signal like that is that the faster the signal is, the more false signals it will give you, right? So for something like that, they say, no, we need a signal that is 100% every time, and that's why they don't announce it until well after it's happened. See, now they should rocket it higher there. I kind of hate that kind of move because it does mess with my head a little bit, because I'm sitting here and I'm looking like, yeah, see, I was right to be skeptical of that move. Could have made some money off of it, I guess, but the counter trend trade is very risky, right? They're also struggling on the way back up from the liquidity holes, so kind of a tough trade. The right trade was to hit into 16, and then it goes through and you're lucky and you go, woohoo! Take your profits and run. I'm seeing this chart on Twitter that suggests that Americans are more confident than British people about defeating certain animals in fights. See? Which percentage of would believe they would beat a grizzly bear in a fight? And there's more Americans that do than Brits, and that holds across the spectrum. Hmm. When Cystic said doing another group therapy. Problem with lagging data is that there's a higher risk of over under reaction, e.g. inflation is transitory or possible over tightening now. Well, okay, so if you're suggesting that the economy is overreacting to news because of the way that the NBER says when there's been a recession or not, there are plenty of different indicators that give investors an idea of what's going on in the economy that they use, and I don't really think that there's really very many people out there making decisions based on what the NBER does, right? And that there are leading indicators and lagging indicators that you can use together and stuff. So here's a spot that if I still really wanted to go long or rather short the micros here, I think I might be able to justify it. I really don't like the volatility here though. I guess I'll do it here on the full size on sim. I'm gonna be a little lazy on it. Okay. Oh, almost. Okay. Best leading indicator is the stock market. I don't know. There's too much noise in the stock market is the problem with that one. Right? But it's the same thing that I'm saying, right? The more leading that your indicator is, the more noise and false signals it'll give you. That's the trade-off for being first, is accuracy, essentially, right? And it's the same thing with our trading. If we're trading on being informed traders, the issue with that strategy is the noise involved with it. So when you have a technical strategy, it should be really consistent. But when you're trading based off of your discretionary reading of information in the market, you get situations like yesterday where you really have a really good indicator or signal, but something else is happening too. It kind of screws it up. So it's not as reliable of a signal sometimes. You can still get really high win rates doing it if you're good, right? But I might do it better than somebody else and vice versa. Because it's so much on the edge, there's going to be a little bit less consistency with it. Okay, so now we are pulling for the news. I guess I didn't want to be, I kind of forgot about that and don't necessarily want to be market making here at this point, but that's okay. We'll see where it goes. I'm going to cancel that order now. For durable goods, spot 3 versus spot 2. Jolt's lower than expected at 10.053 versus 11.087 was expected. Okay, so I don't see anything in that report that's terrible. Factory orders was 0 versus an expected 0. Can you believe that it's back there? So I'm just gonna leave that one alone. Might be time to pull out our live account, right? Shoot. Okay, fine. That didn't quite feel the way that I expected it to, but it did take it, so we're like, why does Google say zero hedge is extremist? They kind of are, to be honest with you. They're not extremists. They have a particular view on monetary policy and economics that is outside of the mainstream view, right? They don't like the Federal Reserve, basically. Like, the long and short of it is they don't like the Federal Reserve. And they promote any content out there that is pushing. So like Schiff, what's this? Peter, is his name Peter Schiff? And he's kind of like a gold bug, right? Okay, here you have this guy that's basically been wrong on markets for like 10, 20 years now, right? And yet every podcast that he posts, Zero Hedge makes a highlight about it. Like, why would they do that for somebody that's been wrong so clearly, right? It's because he hates the Federal Reserve. So that's the first thing that you get. The other thing that you get is that there's a very strong anti-US foreign policy establishment bias. So if so for instance, they have at times been outright cheerleading the Russians, right? I think that they try to present themselves as neutral, but there's been some times where I feel like that they've been pushing Russian propaganda, right? And when the Ukrainians are doing really well, Zero Hedge is just kind of quiet about it, right? So they have very strong biases. But they also post all of this information about what prominent Wall Street research analysts are saying, and some of the best ones that are telling you about flows and stuff. And so they've got very valuable information on the website still. So you have to learn to wade through the trash. They also pushed a lot of anti-vaccine and pro lab leak theory stuff, which, hey, I have nothing wrong with the lab leak theory. Like, as long as you're not presenting it as a factual proven thing, and realizing that it's a theory and presenting the evidence for and against that theory. Well, this is trending quite a bit here. I am kind of sitting here though wondering if they really can break the highs or not. They are shying away from it a little bit. Oh, there you go. Okay, never mind. There was the regular session highs at least. Pretty decent stop run on it, in fact. Was that on all of them? Not on all of them. The 30-year has a little ways to go. What are we seeing? Steepening? Yes, we're seeing steepening. Okay. So one thing is that we are getting inverse sine law here, right? That's kind of why I was able to be like, okay, I think I can flip around and go long here now. But this seems to be going really strong. I wonder if zero hedge, so that here'd be a great instance to use the website, zero hedge. They should have some U.S. factory order steady in August despite ISM manufacturing plunge. One of these things is not like the other. After an unexpected and sizable decline in July, August's factory orders data for U.S. was expected to be unchanged, and indeed it came in right in line. However, there's just one thing. Why is the ISM manufacturing new orders signal collapsing? Nothing here that is worrisome enough to prompt a Fed pivot yet. ... And I don't see anything else. So why is it moving this way? I'm not so sure, but I'm going to take my profits at 31. And I'm going to take my profits at 500 up in here. Because I am seeing a little bit of a liquidity hole for me. I bet you that they go higher a little bit later, but I think that this is a good spot for me. I'm still a little bit nervous about the volatility and all that, so there you go. I think there's a little bit further. Is it gonna give me, how much was that? Okay, 31. Move that one over here. We should look at it over on this. Okay, 585. Oh yeah, I already missed out on 10 to 10. Looks like it's gonna keep going. Although with a couple of big orders here and some big prints up in here, I do think that it's gonna start moderating. So I still think profit taking is justified. Not necessary, but justified. And I was kind of taking them based on the swings that we, because I mean, good grief, we just had a 40 tick up move in the 10-year. So like that's a little wild, right? There's a lot of big orders up above us. That's so when you see it like that, like, okay, what's the next big order above us? Okay, 30. But then there's another pretty big order above that at 14. Well, you'd expect there to be one at 14, but there's also that one at 31. And then we go above that. Oh, look, there's one all the way up at 06. And then a really big one up at 08. That kind of stuff is indicative of large traders set up for a trend day and sequential profit targets above us. And let me check again here. It was 585, right? Yeah, 585. So 15. How do institutions use the treasury futures in their risk management? I can see how treasuries are collateral in the repo market, but not sure the motivation for buying or selling the futures on the secondary market is a hedge. Okay, so yes. So one thing that you can do is you can own the treasuries outright and sell the future against it. And that's not necessarily to hedge, but to make money on the basis. So that's a lot of what the market making that goes on in the treasuries are doing. But the larger thing here is that treasuries are used as collateral for all sorts of things, right? When you're talking about millions of dollars, right? When you're talking about millions of dollars, holding it in cash, you can lose a lot, even in a short period, by just holding a lot of cash. Like that's thousands and thousands of dollars to them. So they don't like to keep it in cash. They like it to be in treasuries, which is as good as cash and can be and is basically counted as cash when they're putting up collateral for various kinds of transactions. For instance, you want to do a big M&A, merger and acquisition sort of a deal. Like you're going to buy Twitter, or you are doing a new IPO. Like these are all things that require capital, right? And so the banks want to have a certain amount of assets in treasuries to be able to facilitate those transactions. That's why you've often had these situations where like going into quarter ends and stuff like that, that there's like this strange demand for treasuries. It's because like they have to have all of this money to be able to do end of month, end of quarter payrolls and all of these other things, and they need treasuries to do those things. And you know, there was periods where the Federal Reserve had bought all of the treasuries, and so they had to scramble to go and get some, right? That sort of thing happens. And as it applies to the repo market, so kind of what happened was now the banks have to have all of these treasuries on hand. Essentially, the amount of treasuries that the market actually needs to function is like a lot higher than people expected or anticipated, is kind of how I would put it. And so that kind of ended up being a problem, because then these institutions have all of these treasuries on their balance sheet that they don't necessarily want to keep, but they have to have. So then they created the repo facility as kind of like a, you know, to let the steam off, so that they can hold these treasuries and still like get something out of it, essentially. And that's why you got like trillions of dollars gets parked at the reverse repo facility every day, because that's how much in treasuries these large institutions are holding that they would probably rather not, but they basically have to in order to transact business. That's my understanding of it. That's a really advanced topic. That's the sort of thing that like Fed Guy 12, if we got a chance to talk to him, that would be maybe something that we would ask about. Or I bet you he covers it in his book. I bet. Well, maybe that should be the next book I read after I'm done with this thing. Hopefully today. Hopefully today or tomorrow I finish that book. Yep, so here they are where I got off. So Fed Guy 12 that's his Twitter name. And he was a senior trader at the Federal Reserve Bank of New York. So in other words, he was like the top dog in trading these things for the Fed side of it all. So he definitely understands that stuff. Yeah. Yeah, Joseph Wang, that's him. That's him. And he does have a book. He does have a book that I haven't read it, but it sounds like it'd be a useful book. Okay, so I got out a little bit early, but my overall read of the flow was correct. So when you get a really big rush of orders like that, usually the first sign that I get that like things are moderating, oh man, it's so hard because you get this first sign and then you go, yeah, like it's probably going to go further. And when do you actually take it and get out? Because if you don't get off of that first stop, you might not have gotten any of these stops, and then you kind of hold it on the way back. And then if you miss it on the way back, now it's gone a little bit further and you're like, okay, well, do I take 25 or do I? And then it comes all the way back and you're like, oh crap. So I'm glad that I played it that way. If I'm not seeing something that makes me think that it should trend all day, I kind of want to take that easy profit. And the news that we got, I'm not quite sure why it moved the market as much as it did, to be honest with you. It was a little weird. I'm sure that part of it was the sell before that, right? So just remember that if you have a market where you have a move down, right? And then as we've moved, maybe there's like, you don't know why this one is moving down, right? But then you have something else happen, like there's a piece of news. So if there's a piece of news to drive you on the way up and there was nothing to drive you on the way down, then that's definitely the situation. Or maybe the piece of news that you get here is stronger than whatever it was that was driving us down, right? Then because of the reverse sine law, you should expect the trend coming back the other way to be stronger. So this is a situation that says to us that it's a better trade, right? If we were, if we hadn't have had such an awful week last week, I might have been going in there with 2 contracts that time, right? Like that's the kind of situation that tells you you could potentially size up because the reward in it is probably better. So that's where you use the order flow, folks, right? You know something, but because you have the market conditions that you know that it's going to go further than usual. That was actually, now that I'm thinking back on it all, it was a good trade. And the other thing that I'm really happy about is that once I realized that it was doing more than just coming back to the 16 and that they were heading for the highs, that I switched around and said, it went from, well, I don't know if I really want to take a trade today. I switched from that to, okay, let's take a quick one. I think I heard you say something like the 3/5 power law. What is that? Okay, so yes, they're all kind of related subjects, so it's a good question. It shows you're paying attention. Okay, so the power law is, let's just review. The power law is the change in price is equal to the volatility omega times y, or sorry, not, we use the y first, so it's like yo, y omega times the square root of the size of the meta order Q over V. And when you plot that, it looks something like this. Okay. Now, the decay function, after a move like that, you get a post meta order regime change that comes back. Okay. And that follows a law of omega times Q over V to 3/5. Okay. So really, I have this kind of drawn wrong. It's really going to look more like, yep. This is going to be, if you divide this into 5, this is going to be 2, and this is going to be 3. Right? So you take the length of this and you times it by 1.5, and that's about how long it takes. Right? And how far it comes back is the 3/5 part too, right? Okay, so that's the pullback, right? And what we're kind of saying is, and let me clean everything so we can see here a little bit better. So what we had was, we had a move down that was like this, right? And then there was post meta order impact. Okay, so there's I have it drawn there, right? Now let's come back and look at the chart. Do you see it? Do you see it on the chart? Right? Strong move down. Post meta order impact. Right? This right here. Oops. This right here is that post meta order impact area, right? In this particular instance, up until the news. Okay? So here's the thing. Is that it takes that 3/5 is basically like, how long does it take for the liquidity to heal, right? So I can do it this way. I have a little tool here. I'm gonna show you. So let's start here from about 7:15 is when the move started, I think. And I have a Fibonacci time extensions tool that is set to be 2-to-1. So if I come down to here, right? Okay. Then it's saying, maybe we should do it from this move. Let's just do it from this, like, because this might have been, no, come on. Yeah, let me redo it. I can't even find it. Okay, I'm gonna draw it again, drawing tools. I'm just kind of realizing that this is also kind of a little bit of a pause. So if we do it from there to there. Okay. Oh, well, if we do it from there to there, then it says it's okay. Properties. This one remove. Why? There we go. Okay, so from that one, we're okay. From that one, we're okay. But from this one, we weren't. Okay, so I guess we will use the original one. Okay, blah, 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 blah. I probably lost your focus here, okay? So we're going from here to here, and we're just kind of like eyeballing it with the 3/5 power law. That means that the market would not be fully recovered and the liquidity being safe until about 8:30. So about right now. About right now is maybe when you do it. Like you take the 2/5 there and then you kind of give it like 10 minutes on either side. Okay. So they could maybe, if they were looking to sell again, they would maybe be looking to sell it again now at this point because it's been long enough, right? But what happened? We had news that short-circuited that before the liquidity healed, right? So if we get a meta order going the other direction before the liquidity heals, then basically that impact function is stronger for this opposing meta order, right? And that's why you get the pattern that you see, right? Now remember, patterns don't predict things, right? Patterns are the result of what happened. So we can see that pattern and we can say pretty confidently that what happened in the market was that there was a large meta order sell for an unknown reason that pushed markets very strongly down to the lows of the session, and then the post meta order impact. And then because of breaking economic news, we had a meta order going the other direction that ended up being stronger than the original move down and pushing us higher because of the damage that had been done to liquidity in this location here. And now we are in the post meta order impact area again, meaning that from here to here, let's draw it again. I'm always doing this in my head and not telling you guys about it, but you asked, so now I'm going to tell you how I'm doing it. Right? I go from here to here, right? Okay. So there was that meta order, and we're in the post meta order impact, and we're past the time at which they would do it. Right? So what does that tell us about current market. Does that mean that we're going to have another leg up? Doesn't tell us that, really, does it? Because it doesn't tell us anything about what the future orders will be. But if we do get future orders, or we know something that will predict future orders, let's just say, for instance, that piece of news that we just got had something in it that made us very, very confident that the treasuries will continue buying all day. Like maybe kind of more like the piece of news that we got yesterday. Or let's say that the piece of news that we had just gotten was like non-farms or something like that. Okay. Then we might be able to say, I think that we're going to continue up. We are at the bottom of the post-meta order impact area. Ergo, I want to go long here. Right? Since we don't know that, I'm not going to take a trade. But here's the other thing, is that if I do take a trade at this point, what should I know? That the liquidity has probably recovered. So while we may get a strong meta order that pushes us up to new highs, it's not going to be like that first leg, right? It's not going to be as strong, probably, because the liquidity is a little bit stronger. Also, if we're not getting another meta order, I've got to be really careful about any kind of like ranging in this area, because I might think, oh man, we're at right here at 25. That means that they're going to break out and go to the highs. But if I'm not getting really good correlated volume coming in, or like a reason to be expecting those orders to be coming through, I got to be skeptical of it at that point, because I know that the liquidity is probably going to keep it in this area. Like the liquidity is going to keep it tighter now than those big moves that we had. Right? That's why it matters. Make sense? Now, I don't want you to be going and drawing those Fibonacci time extensions all the time and stuff like that. It's not really necessary. Just be thinking, okay. Oops. Just be thinking, it takes a certain amount of time for the market liquidity to recover. And that is an empirically proven behavior of markets that we can use to our advantage. And can you see how it's like, yeah, it doesn't predict the future, right? The patterns that we're seeing are only results, but it tells us something about the current market liquidity that we can use to our advantage to manage our risk, right? To tell us when a move might be a really strong move, or it might be a weaker move. When the market is more likely to just get loose and, all over the place, or when it's going to be tighter and it's going to kind of oscillate around a certain price. Does that apply for all markets or just treasuries? Love that question. It applies to any market that is trading a limit order book, because it is the mathematical properties of a limit order book that causes that behavior. Isn't that cool? So they went and they did a study because they got data from Mt. Gox, and they went and they ran all of this stuff on Mt. Gox, and they found that the same square root law was occurring on Mt. Gox. So that's the evidence that causes current market microstructure researchers to believe that it is a behavior created by the market microstructure caused by a limit order book. Is this in that book trade quoter? No, what do you mean? Book map. I mean, this is like a good reason, like maybe one of those examples where it's like, yeah, you want to have a chart up, but you're not using the chart for signals, entries and exits or anything, right? You're using the chart. The chart can tell you volatility. Chart can kind of help you see the meta orders, and you can use that for the current market conditions, so that when you do get a signal, and what's going to be a signal is going to be a predictor of order flow, like breaking news or any other dozens of things that we have. Okay. And it's also going to be like understanding the current liquidity and the range that we're trading in, and are we in a good place in that relative zone? Are you getting a fair price in that relative zone, right? Then you have an entry. And these other things can tell you, how much risk there is to it and whether it's really worth taking or not, right? So in that particular situation, I didn't think that the news was that strong. I was actually a little bit puzzled as to why it was moving so strong, but I could see the order flow was coming through and I knew what the condition was. And so I took it because I knew that we were likely to break those highs. And then because I wasn't really sure about the predictor of order flow that I was getting, how persistent it would be, I just took the quick profit. Such a good example trade. I'm so glad that that happened. That's probably, when we talk about how does Seth trade, that's probably the best example of a continuation trade you're ever going to get. And you saw that from looking, yeah, I did. Well, I mean, I will refer back to the chart. To remind myself that, okay, well, we had to move down. And it hasn't been very long since we had that move down, so the liquidity is probably damaged. Right? But I'm paying attention mostly to the DOM, right? And when you're getting that liquidity, so on the way up, so again, if I'm having a big move up, then what do I expect to happen? There's going to be a point at which that square root law starts to limit how far they can go and kind of starts to drag them back down into the liquidity holes that they've left behind them, that post meta order impact area. And how did I know that that was happening? Because I started to see really big orders up here above 24. So I knew that, and that in just kind of timing, I guess, a little bit too. I knew that it was going to start coming back. I was a little bit too early. But I mean, we're higher now. So I was right. Could have made 10, 15 more on it. But you'll notice that I tend to be early on everything. And I would rather be early than late. Especially on entry. You know, if it's something that, you know, you really think is running, it's okay to try and let it continue through and, you know, lose a little bit more than you really wanted to. Because when it does run, it just runs so much and it makes up for it, right? Because that's the other caveat. I usually don't talk about this part, but here's the other caveat. There's like so the square root law, there's like a very specific domain in which it is relevant, and one of those is the amount of volume that you're talking about relative to the day is still a relatively small amount. So in this situation, you know, we're talking about maybe 10 to 20,000 contracts change in cumulative delta in a market that's going to trade millions of shares that day, right? So it's a very small percentage. But when you get a situation where like everybody's tilted the one direction or the meta order is just too big, then the market breaks, right? And that's when you get the kind of situation like we had last Thursday on the way down, was it? Where like they're selling and it just keeps going relentlessly and you think that it's supposed to pull back and chill out because of the square root law, and it doesn't, it just keeps going. That's what's happening in that situation, right? So you got to be careful about that place where the liquidity breaks. And how do you detect that situation? The best indication for that one is going to be that the liquidity decreases. You have a break, and now after that break, liquidity is not as good. That's a really, really good sign. I mean, it's usually not that clear, but that's a really good sign, is if you see some market makers just like, okay, I'm not going to trade this anymore. Turns the robots off. Market broke down. Because basically the market makers are saying that, because it's in that post meta order area where the market makers kind of like make up for the trend, right? It's like you had this huge trend, now the market makers all rebalance and they kind of make money in there. That's why I like to scalp them. Like, so the trade that I took on the sim orders, right, was basically I saw that post meta order impact and I didn't realize that or I had forgotten that the news was coming. So I was just trying to build a position in that post meta order impact area because I know that there's probably going to be some good ranging behavior there and I can hold risk a little bit, right? This is also the area where you're probably going to see the price action people playing the most, right? It's just that the problem with it is that you can't tell where that spot is. I don't think you can reliably tell where that spot is from just looking at the chart. Could be wrong, but I think it's a lot more clear when you see the resting liquidity. It's really low over and over again, tick after tick after tick. It's doing it right now at 21.5, right? Okay, so that was actually a good uptick, but there was like 127 and then it ticked up and nobody bid and it paused for a second and went like that's kind of a sign that, yeah, liquidity is strained. Market makers are a little bit more hesitant to put up liquidity in the middle area there. Looks like there's still enough volatility for us to shuffle around, but we're definitely in a post meta order impact area from about 24 to 22. But we are probably well enough away that if somebody wants to bring another meta order in, they could. I can't even keep up with NinjaTrader 8's Dom, even with much less numbers. Really? Well, NinjaTrader 8's Dom has so much visual clutter. That's kind of the problem with that one, right? But I'm primarily looking at these numbers just right here on the inside, right? 90% of the time, my eyes are right here, right? Really, this whole line. But I don't pay attention to these ones so much. Like what I'm doing is, okay, 400 by 400, 300 by 500. Okay, so 1470. So it ticked up, but there was an iceberg buy there. Probably you're going to tick back up again. But you're getting on the edge, so I don't think you want to take a trade. You're gonna be, so this is the spot where it says, okay, so if we expect another meta order on the long side, do we want to take it at the higher end of the range of the post meta order impact zone? Well, you can, but it's preferable not to, right? It's preferable that you cut it down here. Okay. But right now, the bids and offers when we tick up are actually pretty healthy. So that one wasn't so good. 85. But, you know, they're able to stack up to like 4,600 really easily, right? Part of that is because of how volatile it is. But they're willing to go. But what I really would like to see is this area where like they pull down to less than 150, like really easily, right? Market makers skittish. Or neither side is willing to put up more than 100 contracts. That's the basis. When neither side is willing to put up 100 contracts and they sit and they do that for like 5 minutes, then you really know that you're in the liquidity hole, right? That's what I'm looking for. And another thing I'll look for is like, okay, we ticked up and then we ticked back down, but I noticed that the 5-year didn't tick up at all. So that says to me that like, well, there's people buying over here, but it's not happening across the curve yet, right? So that can kind of give you a sign too, is because what am I going to see in a large meta order pushing in one direction? I'm going to see the direction of the orders. They're all going to be buy. That the market orders are overwhelmingly going to be buy orders, and I'm going to see that bar after bar after bar after bar, and I'm going to see that in the 5-year and in the 10-year and in the 30-year. And if I'm not seeing it in the 5 or the 30, then I'm going to be looking which way is the spread going. So right now we're steepening. So if we're steepening, then it's okay if I'm not seeing the buying in the 30, but I better be seeing buying in the 5, right? What's that part? That's the correlation. And I'm also going to be looking at why. What's causing the flow, right? So we know that it was news. We know that there was news, but what did the market overall think about the news? What was it about that news that was driving us? Well, let's come and look. The dollar fell. The dollar fell really hard there, didn't it? The 6J, they made an okay move. Okay. So yeah, I think that says that the US economy is weaker than expected, and that's hurting the dollar. And they think that it means that the Federal Reserve is more likely to try and pivot. That's what it's saying. The column to the left of price is a volume profile. Correct. So I don't really look at the volume profile that much. I think it's kind of more of a comfort thing, because if I don't have the volume profile on there, it looks weird to me. I don't pay attention to like where the point of control or the VWAP is or really anymore. But when you are getting a liquidity hold, that place where I find the volume profile useful is that if I get a liquidity hole, I might be saying right here, let's just say that we pushed up to a new high, brand new high. I see big orders at 114, a bunch of big orders at 114, and then all of a sudden, nobody wants to put liquidity on the inside anymore. Okay. 114 is an area that we're likely to create a liquidity hole because it's a round number and liquidity is going to want to trade there, right? So I could say, yeah, there's going to be a liquidity hole here. And the way that I confirm that I was right, if you're right, then eventually you're going to see that end up becoming a point of control of some sort, right? There's going to be a distribution around that. The liquidity holes are what causes these distributions in the volume profile. It should be able to predict those distributions. Oh, you're watching on your phone? Well, the thing is, NinjaTrader 8 doesn't have these two inner columns, right? It says how much it took to buy or sell. Because that's also an important component, because I might see it. I might see, oh, there's only 100 here on the offer or whatever. But then all of a sudden, like 2,000 trades. It's like, oh, there's somebody sitting there with an iceberg is what's actually happening. When you say a liquidity hole, you mean there's a noticeable less amount of orders in that area? It's yes. So I would say it's lower latent liquidity. So normally the inside price has a lot less orders sitting on it than all of the other prices, right? But what I'm looking for is that inside price is unusually low for an extended period, right? Right there, you know, if it ticks up and there's 100 for a moment, that doesn't really matter. What really creates the liquidity hole is when it's like less than, they can barely get more than 150 contracts to bid or offer in an area for an, you know, over and over again. That happens. That's indicative of a liquidity hole. But it can also just be, you can see the predictors, right? If you move through an area very, very quickly, that can create a liquidity hole because all of the market makers kind of go like, whoa, what's going on, you know? Or if there's a really, really big transaction in that area that exhausts all of the liquidity, that creates a liquidity hole, right? Now all of those things are just kind of like my own observations about it. And so that's all very kind of discretionary, right? That's kind of discretionary. But the proven part is that when there are a lot of transactions in a certain area, that it exhausts the number of available orders on the limit side of the book, and that makes it difficult to move away from that area. What is the symbol of the dollar in Ninja? So you can't pull it up in Ninja without my indicator package. So if you have my indicator package, then you can add the synthetic dollar index, and that will give you the dollar index that you're seeing here, this chart right here. And the way that I'm doing that is I'm taking all of the 6J, the 6E, and all of these other currencies and doing a calculation on it to calculate the dollar index myself. And the right data. Yeah, well, you wouldn't need the CME bundle, right? If you only got equity indexes, then it wouldn't work. But I was gonna answer FTH's question and he pulled it. When a big order is resting, why does price tick against it, even when there aren't as many big orders anywhere close to it? Okay, so you're saying, like, if we came up to 113.30, there's a big order there. Why would anybody buy into that order? Is that kind of what you're asking? So you're kind of saying, well, it's a big order. That means that price is less likely to be able to continue through here. So why would I want to buy into that price? Why would I feel that big guy? That's somebody that I don't want to be involved with. That sort of a thing, right? When I confirm, I'll wait for you to respond to clarify. Would the trades of times and sells track the size of a past liquidity hole accurately, or is there no way to track this? I would look at it as if there was a large trade in the time and sales, greater probability of a liquidity hole forming there, yes. Especially if it's really outsized, right? You know, like in this market, everything's been trading like 700, 900, and then all of a sudden you see 3,000 trade in a spot. That's what I saw, and that's why I got out. And just note that, especially if it's a strong trend, when you get that signal, there's usually another push to go a little bit farther, and then it comes back. Because what happens? Here's my theory on that one. I think that what happens is the person executing the large meta order kind of realizes that their time is up, that their period where they can really push things is kind of coming to an end. And so they're trying to shove as much volume through as they can before everybody kind of realizes what's going on. And that's why it kind of pops a little bit afterwards. That's my theory. No, pullback on an uptrend, big buy order, resting too long, but price ticks even lower. Okay, so you're saying we're moving up. It pulls back. There's a big meta order buy there, and it comes through. Because you're thinking, yeah, I want to buy it there for the lift higher, right? That's maybe why that's iceberg is there, right? So why would anybody sell into him, right? It's kind of the question. Well, so the first thing is that you just got to remember that any one large order, from all of the evidence that I've had, at least, does not tend to predict the outcome very well. So again, let's draw a different scenario. We're in a middling market that hasn't been going anywhere for a really, really, really long time. Then we come down over here and I see a large iceberg buy. Does that mean that we are likely to go up this direction? A lot of people will say yes, or at least that's the heuristic that order flow traders tend to use. But my own research suggests that it's not a very good predictor of which way it will go at all. Because I went and I sat and I watched them for a couple of months and like kept stats, and it was 50-50. Those big orders are not necessarily very indicative of where it's going to go. They can be indicative of it's going to stop and not go anywhere, right? Which is kind of the opposite, right? It's not predicting where it's going to go. It's predicting that it's not going to go anywhere in the next like 45 minutes, right? The other side of it is that part of the way that these icebergs work, part of the way the iceberg works is, so these guys, they'll have a DOM, man. I'm sharing too much information. They have a DOM and they're putting a certain amount of liquidity at each price to kind of facilitate transactions and to give themselves a little bit more breathing room. So they're constantly making profit on doing their own market making, even as they're executing a meta order, for instance, right? And so what you could do is you could be saying, maybe I'm half of the liquidity. Like, I know that sounds surprising, but like in some of these cases, that is what's happening. Is this guy, he's maybe like 300 lots, right? So I want to put my meta order here at 23.5. What am I going to do? I'm going to tell my DOM, okay, I don't put any orders at 23.5. Cancel them all so that I only get 134, right? So that the 134 that are left is somebody else, right? And then I put my meta order there. And robots will hit into it because the robots basically say, if the number of orders resting here is below a certain amount, buy into it trying to catch the edge, right? So it's basically exploiting the traders that try and catch the edge is part of it. Another part of it is that the market is trying to facilitate transactions. So they can kind of sit down and say, okay, this guy, he wants to buy. He really wants to buy here. I don't see any reason. Nobody seems to be too excited to do it. We can kind of come back down to here. We can facilitate the transaction and then we can rotate around that to make the money back, right? Or the other thing is that you're hitting into it because like we had when we went through 16, right? When you push through a really big meta order, there tends to be a small pop through it, right? Maybe it pops and reverses there, but usually when they break the meta order, there's a couple of people using that as like trying to protect their stop, and it will blast through it, right? So there's reasons why they trade it. But I guess the biggest takeaway from that is that you just got to keep in mind that like the big orders don't predict which way it's going to go next very well, right? And if anything, the big orders kind of say that we might stop. That's why you notice I don't like big orders. I avoid them because I know that like, oh, if that fills and everything, I used to love the big orders because it's like, that's an aberration. That's something that I should be able to trade, technical analysis wise. But once you realize that it's kind of all just noise, then you kind of say, well, if I don't know what's going on there, why do I want to trade against a huge trader that's willing to put 5,000 contracts up? Why is he doing it? Is he doing it because he's hedging? Is he doing it because he really thinks that we're going to move back up? Is he doing it because he's trying to manipulate the market or try and push it in a certain direction? Like, there's no way for me to know. If I don't know why it's there, maybe I know there's a piece of news and I know that like it's a big deal, but not everybody knows it yet, and there's a iceberg bid. Then I know, and then maybe I would go with it, right? But otherwise, if I don't know why it's there, I don't want to trade it because I know that it's likely to create an area where I'm kind of at a disadvantage. Are there other orders that we can't see on the CME who are out there looking for better prices, and that's why price ticks against us? That doesn't make any sense. So, I mean, everything that transacts you can see in the end. It's just you can kind of, the whole idea of an iceberg is just only show a certain amount of it at a time, right? But when you talk about price ticks against us, when you're in a situation where it seems like everything, the chart and the volume and everything is telling you that it's going to tick in a certain direction, and then it ticks down on like no volume, and you're like, what the F? Probably you're getting caught by a correlated asset. Probably the Japanese yen just ticked down. And that's why I did that. But if it feels, isn't that understood that it's going that way? No. So think of it this way. Informed traders prefer to use market orders. Informed traders prefer to use market orders. It'll be about, like a really good one in the treasuries might be 50-50, right? Market orders are the best indicator that we have of informed trading. That's why you use it. Cumulative delta, best indicator we have of informed trading. That's why I have it on like basically every chart, right? The limit orders, even these big iceberg orders, less likely to be an informed trader. That's why I don't give them much heed. It tells me something about the market. In this situation right now, still seeing icebergs is kind of a sign to me that I don't want to trade. You know what I mean? So they don't care about slippage. Well, they're more worried about missing the trade completely than they are about how much of an impact they're having on the market as they execute it. Yeah, generally speaking. But the other thing that you have to understand with this whole liquidity hole thing is that, again, a liquidity hole, if you can find something that indicates that a liquidity hole is going to be there, if you're right, you're going to see a distribution on the volume profile, right? So the reality is that more volume ends up getting transacted within the liquidity hole than outside of it. It's kind of counterintuitive, isn't it? It's like low latent liquidity. That means that you won't trade very much volume in there. But because it stays there for such a long time in one spot, you end up transacting more volume there than elsewhere, right? Are we getting another move here? Ticking all over the place, and then it just kind of stopped. I don't know what the deal was with that. Okay, so they will create the liquidity holes on purpose, right? You come in with a meta order, you push it, make the liquidity hole happen, and then just kind of slow your algorithms to a trickle to just kind of put a little bit of volume in at a time, and you're going to get more of your order filled there in that liquidity hole than anywhere else, right? So to some extent, you're seeing those moves that we're kind of looking for. They're creating those on purpose because it actually, by moving the market a little bit, they actually get a better prices on their trade overall. Does that make sense? No. So if you're looking at it on a tick by tick basis, and you sit down and you say, okay, if I'm looking at the level 2, why does it like tick up or down, and what are the things that I'm seeing that are more predictive of whether it's going to tick up or down, right? Then the thing that you're going to find matters the most is when orders are pulling out of the way, right? And you're going to see that tick after tick after tick, right? But you're looking at that on such a micro scale. Really, all you're just seeing is correlated assets moving things around and people trying to catch the edge. And so it seems like that's the most important factor. But when we come in and we look at a strong trend, right? Strong meta order going one way, what are we going to see in cumulative delta? Strong auto correlation in cumulative delta every time. And why is that? Because large meta orders are a significant part of our markets. The resting liquidity is not enough for these really, really big institutions to transact their trades. And so the large meta order, if you put it all on the limit, might not get filled. A hedger that's maybe doing 1,000, 2,000, 3,000, they're probably fine. But like the sovereign wealth fund of China that wants to get rid of all of their bonds, or all of these pension funds that are selling because of the stuff that's going on in the UK, they have to use market orders. They have to. They won't be able to get rid of it all. The market will just get away from them. So, like a part of it is the way they were trying to trade, right? Because the way they were trying to trade is we're trying to be informed, right? So what is the best indication that we have that there's some informed traders out there that feel as we do, or that we're trying to shadow? So this is going to be the market orders, auto correlated flow in the market orders. It's going to be your best sign. You know, on the liquidity side, you see those orders canceling too, then that's kind of the indication on the limit order side. But I don't care about those as much. And I definitely don't care about the, well, it's not that I don't care about the big orders. It's just I very much avoid whenever you notice, I always say, okay, there's a big order. We'll see what happens, right? Because I know that it doesn't predict what's going to happen next very well, right? I'm always kind of looking more at what are the flows that are going to be in here today. Why do you think they sold going into the S&P 500 open? Do you think that that was like the UK pension funds again, like it had to do with gilts? Because it's been selling around that time every day, and it sold particularly yesterday and later on we got a news story that they didn't buy as many gilts as the market thought they were going to. So I'm wondering if that's why we had the move down. Well, either way, I always kind of feel weird after a thing like this, because like basically what happened was I had a really good trade and then I taught a bunch because I was all manic about getting the good trade, right? But it was that you guys asked a bunch of good questions and you were able to pull a bunch out of me. Although I think for a lot of you guys, stuff that you already knew, right? Like Tobias, you've been around long enough. You've heard these rants before now, I think, at this point. But Trading Bunny, that's probably gave you the best. Hope you understand it now, because that's about the best I'm ever going to give you on that whole bit. I mean, these are the same things that I'm trying to tell you guys in the stylized behavior of markets and inelastic theory of markets videos. It's just that I'm walking you through it in how you see it in the market, right? And it's really best to learn that stuff live. I could make a video about that, but I don't think that it would be as beneficial to you as people coming in and watching the stream and seeing me walk through it. Because when you see me walk through it, and of course, some of that analysis we can only do after the fact. But once you see it go through the analysis, don't you agree that that is a much better and more consistent explanation for why price behaved the way that it did compared to like what some of these price action theories say, you know? Because how do you know, especially with this one, we had a move down and then we had another move back up that was even larger than the first move. How do you explain that with price action? That just doesn't, you know? But when you understand the inverse sine law, now it's like, oh, now you can identify that and use it all the time. Those will be some of your best trades. All right, time for me to go, guys. I will see you tomorrow. In the meantime, stay profitable.